Hello everybody and welcome to Green Star Trading with me, Tom. All views, opinions and ideas expressed in this video are my own and do not constitute financial or trading advice in any way. Right, welcome back to YouTube, and today we're going to be looking at the S&P 500, well specifically the SPY ETF, which is our proxy for the US stock market. And we're going to be doing some Elliott wave and we're going to be doing some classical analysis as well. But before we do that, okay, I just wanted to take a moment of your time to talk about the Green Star Trading Patron and why I think you should consider joining. So, one of the things I really want to get across, and has been brought up several times by our members, is this is not a expensive subscription service. Okay, you can sign up for 10 quid a month at tier 2 and you can leave the next month if you want. During that month you will get the weekly updates for the major moving markets of the gold, SPY and Bitcoin. I occasionally change out gold for oil or something, but you get a market update each week. You get access to all of the previous educational content I've ever produced, including the Elliott Wave series. You get access to a public Discord with multiple channels where you can discuss things with our other members. You get access to live streams where I cover the exact assets you want me to look at. There's a specific channel for you to make those requests. Sometimes these live streams are 2 hours, 3 hours, sometimes even 4 hours long. And that is just for £10 a month. And like I said, you're not obligated to stay. If you want that and a little bit more, you can join for £15 a month, get everything I've previously mentioned, plus a dedicated series called Watchlist, where I look at the specific assets I'm currently interested in and go into great detail in the analysis of those assets. You also get access to the monthly dividend calendar and stock rating system. So I think it's a bargain, guys, and like I said, my whole mission with this channel over the last few years is to just try and help people get their heads into trading, into investing in a way that's affordable, isn't going to break the bank, isn't going to screw anyone over, and just try and push them in the right direction to help them develop their own skills and their own interests. You know, I'm not a guru trying to market £1,000 program or any nonsense like that. So it's totally up to you. There's a link in the description box at the bottom of every video, and if you want to sign up, feel free, but it is the best way to get regular updates, the best way to get access to all of the benefits I just mentioned, and to all the extra content that isn't available here on YouTube. So if you do choose to sign up, be aware there is a free option, but this is a nonsense option. It's something that Patreon forces upon all of us creators, and it will give you access to absolutely zip. There are 3 tiers, tier 1, tier 2 and tier 3. Tier 1 is just your opportunity to make a donation directly to Green Star Trading to help me continue my work on YouTube, but you will receive no further benefits after that other than knowing that you're a wonderful person and you have my thanks. If you want to gain something from it, then should consider joining tier 2 or tier 3, the aforementioned £10 a month or £15 a month. Alright guys, thank you very much for your time. Now let's get back to the video. Okay guys, welcome back. So first things first, I want to let you know there's a video on its way to you now, which should be along shortly after this one, called Long-Term Investing is Simple. Now the reason I recently made that is currently available to my patrons here who can watch it via the Discord and via the Patreon. So the reason I've made it is we've just gone through new all-time highs, right? There's always more interest in the stock market when this happens. The same with Bitcoin or the same with gold or anything else, right? And it tends to draw in new blood. And new blood may be people who are returning to investing, returning to trading, maybe brand new people who just, heard how their friend or their family or a neighbour is doing well in the markets and they want to get in. Now, before you jump into the rabbit hole of complex technical analysis such as Elliott wave and indicators and moving averages, and then fundamentals such as the ISM and interest rates and money supply and foreign bond purchases, and before you dig into the rabbit hole of managing a trading portfolio, managing risk and exposure and all that headache that fools like me have devoted a lot of their life to, turned it into a profitable endeavour, but life could have been a lot easier. And it might be for you, it might not be for you, but the point is, if it's not for you and you haven't got the time to do any of that stuff and you haven't got the resources available to commit to learning all of that stuff, then maybe there's a simple alternative. In fact, there's a 100% successful, historically back-tested alternative which has always been profitable, and that's what that video will be about, and that might be for you. So if you are just becoming interested for the first time in the stock market, stop and have a think about how deeply you want to go into this world, and if you want to take the easy way out, take the easy way out, or do nothing at all. But if you want to take that easy way out, believe me when I say that long-term investing is simple. Anyone can do it. It's mostly jargon and nonsense, handing the responsibility over to fund managers so they get paid their 2 to 5%, but you can do it for yourself and it's a piece of cake, and that's what that video is going to be about. All right, so trading and complex technical analysis and all that stuff isn't for you. That's probably the way to go, and that should be available shortly. So anyway, let's get on with today's video, where we are going to be going on and on and on about technical matters. We're going to be looking at the PCC, the VIX, as well as the SPY, but we're also going to be looking at Elliott wave counts and some classical analysis as well. So first things first, I want to start, I think, with some classical analysis. So let's do that. Right, so as I said, we've just come for an all-time high, and we're going to, on the daily time frame, bring up our exponential moving averages, and we're going to see where we are. We're going to bring up our indicators as well. So on the daily time frame, we can see that we came back for the 250 exponential daily moving average, which is typical of a larger wave degree correction. We dragged all of the moving averages down with us, including rolling the green 250 daily exponential moving average over to a lower low, or to a higher low, I should say, excuse me. And we had extremely powerful volume at the low here, very deep bearish signals here on the MACD, very oversold conditions on the daily time frame, and the break of the prior trend, or the trend line on the OBV on the daily time frame. So a clear, significant breakdown in the market, one that I would argue represents a larger wave degree completing in Elliott wave and not part of a continuous move up. But we'll talk about that later. Since then, we have moved back above the 10, the 20, the 60 and the 250 exponential moving averages, thrust our way to a new all-time high, and dragged all of those lagging indicators up with us, and we are currently trading above all of them, with the pre-market trading above Friday's close. So on the MACD, we're back above the zero bound with the average and the signal line. We've had a period of consolidation here and weakness, divergence between the highs in price and the highs in the MACD, and now we've crossed over with the average for the signal line, with a little green bar appearing on the histogram here, but still in positive trending territory above the zero bound. So we've either consolidated here, right, and now we're going to explode, or this is all bearish divergence into a high. It's very difficult to tell. If this had continued to trend down towards the zero bound and with the average line below the signal line, I would have suggested that it was bearish divergence. But now that we've had this little green pip, this little crossover, that's enough to suggest that there is a possibility that we're actually much more bullish than we first appeared. So then we look at the RSI, we see the same divergence between highs on the RSI, and we can see how we've now come back up into overbought conditions, but this current high is not particularly weaker than the prior one, thus explaining this slightly bullish shift in momentum. We can also see on the OBV that we are confirming new highs with the OBV on balanced volume, and there is no divergence between these highs. So the signal which was building up here, and across the MACD and across the RSI, which was suggesting weakness and bearish divergence, has disappeared in the OBV, and it may well start to disappear in the RSI and in the MACD, in which case we could be on for a bit of a sustained rally. Obviously it's still early days to call that, but we have just gone for new all-time highs, so we often retrace for a bit after going through, or we tend to pop. It's one or the other. We'll see. And now we'll just go sideways just to confuse everybody instead. If we come out to the weekly time frame, we can see that same correction brought us through the 60 exponential weekly average, did not bring us down to the 250 weekly exponential moving average, suggesting that this is a larger wave degree, but it's not as large as this one back here, so it's likely a subwave of this larger wave here, and that's why we didn't come all the way back. We had immense volume off of that low, incredibly strong bullish signal off of weekly oversold conditions and extremely bearish momentum on the MACD. We saw multiple weeks of bearish divergence throughout these weekly highs building into this correction. We knew it was coming. We saw it play out. The OBV has returned not yet back to the higher new highs, and therefore there is still weakness here in the weekly time frame, but the correction's only just completed. We can see on the daily time frame there is will to push higher. We're still trending positively at the moment on the RSI on the weekly, but we're not above the 70, not into overbought conditions yet. Green bar still growing on the histogram, still looking relatively strong. On the monthly time frame, we had probably the single most bullish candle I have ever seen on a monthly time frame in the United States stock market. If you go back to the video when this low came in, I pointed out this absolutely massive dragonfly candle and a huge volume at the low, and made a pretty bold statement, but that this was a buying opportunity. In fact, I put several videos out at the time, one called Fear and Opportunity, another one following that up once we got this monthly close, that this was obviously a reversal. You never ignore something as clear as that. It's not a guarantee, but you never ignore it. Okay. Now on the monthly time frame, we have still have divergence between the recent highs and the all-time high and the high back in January, February 2025 this year. Now the OBV continues to march higher over the longer term with no clear break of trend at all, still looking like a very strong long-term bullish trend going all the way back to the global financial crisis. It looks perfectly intact. There is, like I said, a little bit of weakness on the RSI as well between recent highs and current highs, but longer term highs, in other words respecting the monthly time frame we're observing, have confirming bullish signals. So we are higher in the RSI, higher in the MACD, higher in the ABV. So the monthly time frame, the high back in 2022, January 22, and the high all the way up here in January 25, this 3-year period, we are lockstep bullish. Right, this is not a macro monthly time frame top between these highs, and obviously that has now been confirmed that it wasn't, because we've now since made new all-time highs. But between the more recent highs, there is weakness on this time frame. We can see how we don't larger time frame corrections come back to a 60 monthly exponential moving average at larger wave degrees, and that massive corrections come well through it. So for example, this is the tech bubble, and this is the global financial crisis. Right then, so now let's come into the Elliott wave part of the video, shall we? We're just going to turn off that little all-time high ticker thing there. We're going to come all the way down to the 8 hour, and we're going to start talking about longer term counts and shorter term counts. So dealing with everything from the low of October 2022, where we had our signals from the PCC and the VIX and oversold RSI conditions. We got a later signal from the VIX and the PCC. We got an earlier signal here as well before we actually made our final low with the RSI, and then divergence into that low. Bullish divergence into this low. From there we found our market bottom. We were pretty confident it was a market bottom, but until we breached that high back in August 2022 into this swing high here is when we started to count bullishly higher and expect continuing high prices all the way up to new all-time highs and beyond, which is what we've done. So the way we can explain that over the longer term is this primary count, that we had a wave 1 into a wave 2 as a expanded flat, running flat actually with an expanded B. We then had a 1, 2, 3 and 4, 5 minor waves into intermediate 3, a quick zigzag down into intermediate 4, 5 waves up into intermediate 5 to complete primary 1. We can look at this completed zigzag correction here, a sharp correction, as the completed larger wave degree. As I pointed out on the daily time frame, if we look at our exponential moving averages again, this sustained correction here below the 250 exponential moving average brought us down to the weekly average at 250, but this one did not. This one is smaller than this one. This one is a larger wave degree. That's the logic I'm using. And from then we have come back up to test the trend at new all-time highs, and that is where we've gotten so far. This we'll look at in a small. We'll look at the details of this for the shorter time frame in a minute. The alternative is that we're still in a 5-wave move up. 1 and 2 sideways correction, 3, 4 sharp correction, alternating the wave 4 to the wave 2 with 5 waves up at minor degree into intermediate 3, completing an ending diagonal. Now the problem with this is when we take an Elliott channel, we place the bottom of the channel on the wave 2, copy on wave 4 and project from wave 3 to find the wave 5, right, we don't get a very good look at all. Although this is a sharp correction, the wave 4 is so deep it's a 50% retracement. Now, yes, it is a sharp, so sharps tend to be deeper, and yes, it does alternate with the sideways. This is the reason why I'm considering it as a valid alternate. Structurally it's sound, but in practice it has pretty poor form, and a 50% retracement is far more likely to be a wave 2 than a wave 4. Wave 4 tends to settle between the 23.6 and the 38.2. So that's the alternate at the longer term. So just to recap, primary longer term completed the primary wave 2, now moving higher, looking for an intermediate 1, intermediate 2 pullback. And in the alternate, we are working on 5 waves higher, looking to complete a larger wave degree here before pulling back. And that's essentially the Elliott wave count for the longer term. So now let's focus in on the shorter term. So this is everything from the low of April this year, 7th of April this year. So we were pretty confident that we called the low down here. We saw a lot of evidence that it would be, and I made the concerted effort of telling everybody, you know, that we don't look a gift horse in the mouth. When the stock market sells off a significant amount, we buy it. We give it the benefit of the doubt if we start rallying off a strong volume, momentum and oversold conditions, and we've been anticipating the all-time highs since they've arrived. Now, were we going to have a pullback before we got there? That was part of the discussion. How have we come up so far? Part of the discussion. And it's, in that regard, has not been simple. And the things which have been throwing me off and tripping me up a little bit is this 3-wave move into the initial swing high here before the swing to a higher low. Traditionally, a 3-wave move, if its motive is the beginning of a diagonal, and it looked very diagonally for a while, if you see what I'm about to show you. So 3-wave swing here, that's 1, that's 2, that's 3, that's 4. We can continue up to here for 5 if we want to push it like this and say, well, there's a diagonal there. We can end it early, and we can say actually it was this all the way back here, and this is 1, 2, 3, 4, 5. Either way, the price did not correct as though it was a diagonal. It just continued higher and higher and higher, suggesting that it probably wasn't a diagonal of any sort, and it's actually something else we're dealing with. So the alternative is to look at the sheer violence and the speed at which we gapped down into this low, as we made a 3rd wave here, 4th wave correction, and the 5th wave truncation. Truncation being when the 5th wave fails to extend beyond the completion of the 3rd. It is a rare occurrence, but in extremely volatile circumstances it can happen. And that may be an explanation for what we've witnessed here. So rather than counting this as the low from which we're going to pursue our Elliott wave count, we should probably be considering this as the low instead, but with the caveat that we are considering a truncation and therefore overall a less likely option than a better explanation. So what do we end up with there? Well, we've got several ideas, and this is where it gets a bit annoying and a bit complicated. I wish I could tell you there's only one idea, but there isn't. So off of that truncated low, we get a 1 into a 2, we get a 3 into a 4, we get an expanding ending diagonal. Wave 1, wave 2, wave 3 is larger than wave 1, wave 4 overlaps wave 1 and is deeper than wave 2, wave 5 will be longer than wave 3. That's the rules for an expanding ending diagonal. There is no upper wave limit, there is no price or percentage extension wave limit. For the wave 5, it tends to be a structural thing with expanding diagonals rather than a target. So it could be the 1618 of the 3, it could be the 2618 of the 3, it doesn't really matter. Traditionally, and I say that loosely because we're talking probability rather than rules, we have these expanding structures, and the 5 tends to complete prior to the wave 1-3 trend line, as opposed to a contracting ending diagonal, which is not a expanding wedge but a contracting wedge, where more commonly the 5th wave actually throws over the top and then comes down. In an expanding version, the 5th wave often completes prior to the 1-3 trend line. So we haven't got much room between us and it. Now, it doesn't invalidate the count, but it does reduce the probability of it being correct if it goes through that trend line. So we have to have alternate ideas in place. Okay, so what are the alternate ideas then? So we've got extended 5th as our first idea. which is that we've come off of that truncated low and we've had a 1 into a 2, 3 into a 4, ending diagonal into a wave 1 of a lesser degree into a wave 2. So what does that mean? Well, let me just simplify it. We've gone 1, 2, 3, 4. Now we're into a fifth wave. This fifth wave is bigger, broader and expanding, and is an extension, so it will be significantly bigger than the 3 and the 1 possibly. And we're going to go into it like this: 1 into 2, now we're going to go 3, 4 and 5, and this is going to be the fifth wave, going up to new highs, right, and continuing. So we're going to get a strong finish, and looking for another wave 1 and another wave 2 at smaller degree here to complete. So 1, 2 at minor, 3, 4 at minor, 1, 2 at minute, 1, 2 at minuet, 1, 2 at sub-minuet, so on and so forth. Expecting the typical wave 3 extension, the 3 is often the longest of any wave, but it could be an extended fifth of a fifth. We won't know until it's done. But the idea here is essentially that we are not going to get a retracement from here. We're going to explode higher. So we've got 1, 2, 3, 4, and now all of this is the fifth. If that's not bullish enough for you, we have a wave 3 extension count instead. Coming off of the same truncated low, we have 1 and 2, and then we have 5 waves up, 1 and 2 at minor degree, 5 waves up, 1 and 2 at minuet degree, 5 waves up, 1 and 2 at minute degree. If we explode at a fifth extended wave, will eventually complete and then roll over into a larger crash. This version, the wave 3 extension, has got a lot further to run, and it will not crash for many months, if not even more than a year or two. So this is going to really go higher, alright, if this is the case. I'm going to lean into the ending diagonals, my primary first, as I do feel there is still weakness into these highs, which I previously discussed. Okay, but if that weakness disappears on the 8-hour of a day, the 4-hour, 8-hour daily time frame, and we continue to push higher, we have to adopt a more bullish view. Okay, so anyway, there are all the bullish counts. So a quick summary: we've looked at primary and alternate longer term. We've got ending diagonal, looking for the fifth wave of a wave 1 to complete before a larger correction down, completing another wave 2. Then we've got the idea of an extended fifth. We've done 1, 2, 3, 4 waves already. We're now in the fifth wave, and we've done the 1 and the 2 of a smaller wave degree of that. So we still have an explosive move higher to come, which will take several weeks. Then we've got the wave 3 extension idea, which is we're at 1, 2, 3, 4 wave degrees complete at wave 1, 2, 1, 2, 1, 2, 1, 2. We are now in wave 3 of minuet, 3 of minute, 3 of minor, 3 of intermediate. This is many months, if not years, of work to get to the high. So this is by far the most bullish. Now let's wrap things up with a bearish idea. So we came to an all-time high, but bears like to clutch at straws long after they should have drowned. So there's always the possibility that this is a flat pattern. So let me just explain. Here's the previous all-time high. While coming down here, the bearish view will be that we're going to come down, we're going to correct, we're going to go lower. That didn't happen. So if we make new all-time highs instead, we look at, from a bearish point of view, all of this move as a corrective 3-wave move back into the high. And then this simply becomes A, 3 waves, this becomes B, 3 waves, and this becomes C, 5 waves. A 3, 3, 5 flat structure, the most common of which is the expanded flat. And that's what we'd be expecting here if we're going to be bullish. So we've come down in an A, we're coming up in a B, we're in the target box for a regular flat to expanded flat, which is all the way from the 89% fib retracement of the wave A all the way up to the 1618 extension of the wave A. It's a pretty big range. This is our target box. We cannot predict the C target until we have a bearish reversal in place and the break of that upward trend. Then we can point to the wave 1 being on the way, and then the wave 2 pullback, 3, 4 and 5 down, and we can project that target once we know the height of the B. So we can project the A from the completed B to find the C. Typical targets are the 1618 extension or beyond. Okay, sometimes shallower if you get a running flat, but that's less common. And that's the bearish count. So now let's move on and have a look at the PCC and the VIX. Now we know historically that between our VIX extremes, our PCC extremes and VIX extremes, combined with our oversold readings in the RSI, we're pretty darn good at calling market lows. Okay, they're pretty reliable. So we will be keeping an eye for the kind of extreme conditions on the opposite side for tops when they occur as well. Much harder to call than lows. Lows are way easier to call than tops. Because the conditions which bring about a market low are much more commonly experienced than those that bring in the market highs. What do I mean by that? You may have been making a hell of a lot of gains going to higher highs. You may already be euphoric. You may already be like, oh my god, I can't believe how well I'm doing. And there are still people who aren't even in yet, who are going to arrive weeks and months later and pile more money in. Right? That's a much longer process, topping out. There's an old saying which is used to warn bears against shorting the market, which is the market can remain irrational longer than you can remain solvent. The lows of a market are much more commonly experienced by all participants. There are no new people coming in when the market's crashing. Everyone's getting out. Okay, and they're panic selling. So that's a much more common and shared experience, which is fear, uncertainty and doubt, and panic. And therefore the lows are way easier to spot. But anyway, I digress. Let's move on and have a look at the PCC. So looking at the day time frame here on the PCC, using our 60 and our 250 exponential moving averages to smooth out what is essentially an enormous amount of noise. Okay, when we look at the daily data, it's a little too much to really make any use of. So we smooth it out using the 60 and the 250. We can, if we wish to, change that to include multiple others as well. We can have, for example, the 10 to show more short-term volatility, or the 20, slightly less. But either way, over the longer term, when we get down to the extreme complacency and bullish line, historically we're forming market tops. Okay, and when we get down, or when we get above the extreme fear and bearishness line, we're forming market lows. We've marked all of these market lows on the PCC and we've crossed them over onto the chart, and we've seen how accurate these lows tend to be. At the moment, we're still a fair way away from long-term extreme complacency and bullish. We are in the complacency and bullish area of the market, but we're not near the extremes yet, and we're still trending down in a series of lower lows and lower highs, with both the 60 and the 250 exponential moving averages moving towards complacency and bullishness rather than towards extreme fear and bearishness. So we are still generally bullish. But the day will come when we get a little too bullish. Right, let's move on and have a look at the VIX. So the panic line, I have it as the 50 on the VIX. You might put it somewhere else, and it's not a accepted idea or an accepted form of analysis. But for me, when I look at the historical volatility of the S&P 500, moves above 50 are rare, and they tend to elicit panic. Right. So we have a bunch of them listed here. We have, for example, the global financial crisis, the GFC, which is the highest reading we've ever had. 96.4. We've had COVID, which was 85.47. We've had the 2024 recessionary fears, which was 65.73, and we've had recently trade war panic at 60.13. This is our latest spike. And then these spikes are still generally far apart. They're not a million miles away. These two are relatively close, but generally events which take us above the panic line are pretty rare, and after going through it we tend to spend long subdued periods back down below it. Now we could keep doing this and we could just be entering a more historically volatile period of the market, but generally the trend is that once we've had a spike we tend to trundle along again. Now there is an underlying upward trend in the short term on the higher lows, okay, and we have seen this long-term downward trend line breached as well, but we've now returned below that. So we'll see if we continue to trace inside of what could be a triangle. If we move back below this upward trend of volatility, we're likely going to come back to longer term support and form some kind of new low. We've done this multiple times before. Okay, along trend lines that held for a very, 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 very long time, then it broke. So for the meantime, volatility has returned back to below 20. It is elevated slightly over the longer term, coming up in higher lows, If that trend breaks down, we can expect volatility to disappear for a while, and then normally it's quite a long period of time, not always, but a longer period of time between these 50 plus spikes in the VIX, which tend to be synonymous also with our little green lines here that we've marked with market lows. So if we were to take this line here, which is the 4th of April, and we will say VIX extreme, because it was an extreme above the 50, and then we can come back to the SPY and we can mark the 4th of April for our VIX extreme here. There it is, and we can put that into our little folder of VIX and PCC extremes, and we can see that the PCC oh no, that was the RSI reading, sorry, let's remove that one. So there's your low, there's your extreme reading in the VIX, there's your historical extreme readings in the VIX. Low, that low was a higher low, admittedly, that low was a precise low, that low was a precise low, this low was a precise low. So the lesson is very simple, isn't it? And we touch on this in this new video I'm going to put out tomorrow from your perspective about investing made simple, which is be greedy when others are fearful. I know it's an old saying, and I know you're probably sick to death of hearing it, and some of you are probably rolling your eyes at it, but the old man was absolutely right. When the bears are at their most confident and most certain that it's the end of the world, you should be buying the shares they're selling you. It's pretty much that simple. So anyway, guys, we'll wrap it up there. I think we've basically covered everything we want to cover. I know it's not particularly clear at the moment. If I had to pick a count, I would say I'm going to lean into the idea of this being an ending diagonal, and we will complete a larger wave 1 now that we're at all new all-time highs sometime soon. We'll then roll over into a larger 2. If all of the divergence that we've seen, this weakness between highs on the MACD, weakness between highs on the RSI, if this is being confirmed as incorrect by the OBV making new highs, we push the new highs on the RSI and the MACD, then I think we have to give up on this idea and support either an extended 5th or even a possible extended 3rd, which would be extremely bullish. Remember also that the bearish count can push a lot higher yet before it finds rejection. So we're in a bit of a no man's land. Either way, a little too late in the day to be chasing it unless you're using tighter stops off of recent lows. No, so what do I mean by that? Your most recent significant low, swing low, or part of this upward trend was back here on the 23rd of June, and that is already from pre-market price 4% away. So you'd be looking at a 4% stop, and you are backing a bullish count at that point, either the extended 5th or the extended 3rd, because you would not be buying from that low and using a stop from that low if you felt we were about to top out. So that is your call to make. Alright then, guys, thank you very much for joining me on this technical analysis of the stock market. If you're new to the channel and you like what you're seeing, please subscribe, smash the like, hit the little bell icon to remain informed of future video releases. And if you're interested in Elliott Wave and want to learn more about trading and stuff, feel free to sign up to Patreon, as I mentioned in the advert earlier. And yeah, take care of yourselves, guys. Keep an eye out for that future video I mentioned. I'll be back with you as soon as possible. All the best. Bye bye.